Ladies and gentlemen, what if I told you that one announcement coming out of Russia could change the outlook for gold and silver investors worldwide? Most people are focused on stock markets, interest rates, and daily headlines. They're missing the bigger story. Behind the scenes, major nations are quietly reshaping the global monetary system, reducing dependence on the US dollar, and increasing their focus on hard assets. Russia's latest moves could be another signal that this transition is accelerating. If you own gold or silver, or you're thinking about it, you need to understand what may be happening before the rest of the market catches on. For decades, the global financial system has revolved around a single assumption that the US dollar would remain the dominant currency for international trade reserves and prosperous settlements. Investors became so accustomed to this arrangement that they began treating it as a permanent feature of the economic landscape. History tells us otherwise. Monetary systems are not permanent. They evolve, they adapt, and eventually they are replaced by new structures when economic and geopolitical realities demand change. What we are witnessing today is not a sudden event, but a long-term process that has been unfolding beneath the surface for years. The signs are becoming increasingly difficult to ignore. Nations are actively seeking alternatives to dollar-based transactions, building new payment networks, strengthening bilateral trade agreements in local currencies, reducing their exposure to financial systems controlled by foreign powers. These actions are not isolated policy decisions, they are pieces of a much larger strategic puzzle. The important point is that this shift is not driven by ideology alone, it is driven by risk management. Governments around the world have watched how financial sanctions, asset freezes, and restrictions can affect access to global markets. As a result, many policymakers have concluded that excessive dependence on a single reserve currency creates vulnerabilities. Whether that assessment is correct or not is almost beside the point. What matters is that decisions are now being made based on that belief. Most investors focus on stock indexes, quarterly earnings, and central bank interest rate decisions. Those factors certainly matter, but they often distract from deeper structural changes. The international monetary system operates on trust. Once countries begin questioning existing arrangements and actively preparing alternatives, the foundation starts to shift. These transitions rarely happen overnight. They occur gradually at first and then seem sudden when the accumulated effects become visible. The historical parallels are worth remembering. Reserve currency transitions have occurred before. The shift from the British pound to the US dollar was not completed in a single year, even a single decade. It unfolded through a series of economic, political, and financial developments that eventually altered the balance of power. Today's environment shares some similarities. The difference is that information travels faster, capital moves instantly, and financial markets react with unprecedented speed. This is why investors should pay close attention to developments that may appear disconnected from their portfolios. Currency systems influence everything from commodity prices to bond markets, inflation expectations, and capital flows. When nations begin restructuring trade relationships and reserve management strategies, the consequences extend far beyond foreign policy. One of the most significant implications is the growing importance of tangible assets. Throughout history, periods of monetary uncertainty have consistently increased interest in assets that exist outside the traditional financial system. Investors seek instruments that cannot be printed, diluted, or created through policy decisions. That pattern is repeated across centuries and across continents. The broader message is clear: the world is moving toward a more fragmented landscape. The era of unquestioned monetary dominance is facing challenges from multiple directions simultaneously. While the process may take years to fully develop, the trajectory is becoming easier to recognize. Smart investors understand that major financial transformations are often visible long before they are acknowledged by the mainstream. By the time the headlines declare that the system has changed, the most important moves have already taken place. The mainstream financial community treated gold as little more than a relic of the past. Economists dismissed it as an outdated asset. Portfolio managers viewed it as a niche allocation, and many investors assumed its monetary role had ended decades ago. Yet, while public attention remained focused on stocks, bonds, and digital assets, something important was happening behind the scenes. Governments and central banks around the world were steadily increasing their interest in physical gold, not as a speculative investment but as a strategic monetary asset. This distinction is critical. When individual investors buy gold, they are often seeking protection against inflation, market volatility, or currency depreciation. When governments accumulate gold, they are thinking about something much larger. They are thinking about national reserves, financial stability, and the long-term resilience of their monetary systems. These decisions are not made on the basis of short-term price forecast. They are made with decades in mind. The reason gold continues to attract attention from policymakers is simple. Gold is one of the few financial assets that carries no counterparty risk. A government bond depends on the issuer's ability to repay. A bank deposit depends on the health of the banking system. Even reserve currencies depend on confidence in political institutions and economic management. Physical gold stands apart because it is not simultaneously someone else's liability. It exists independently of promises, contracts, or political decisions. History repeatedly demonstrates that during periods of financial uncertainty, confidence becomes the most valuable commodity in the world. When trust in institutions begins to weaken, market participants naturally seek assets with a proven record of preserving value. Gold has served that function for thousands of years. Civilizations have risen and fallen, currencies have come and gone, yet gold has remained relevant through every major monetary transition. What makes the current environment particularly significant is the growing recognition that the global financial system may be entering a period of structural change. Rising debt levels, persistent fiscal deficits, geopolitical tensions, snorts, and concerns about long-term currency stability are forcing policymakers to think differently about reserve management. In that context, gold offers something few other assets can provide: neutrality. It is not tied to the economic performance of any single nation. It does not require confidence in a specific government. It functions as a universal, recognized store of value. Many investors mistakenly focus on gold's daily price movements while overlooking the broader strategic picture. The most important story is not whether gold rises or falls over a particular month. Important story is that institutions responsible for managing national wealth continue to view gold as an essential component of financial security. Their actions suggest that gold's role in the monetary system may be expanding rather than diminishing. Shift has implications that extend far beyond precious metals markets. If gold is increasingly viewed as a strategic reserve asset, demand can grow independently of traditional investment cycles. Unlike speculative buying, strategic accumulation is often patient, deliberate, and long-term. It reflects a fundamental reassessment of risk rather than a temporary market trend. The lesson for investors is straightforward. Gold should not be analyzed solely through the lens of inflation, interest rates, or short-term market sentiment. Its significance reaches much deeper. It represents confidence, liquidity, and monetary stability in a world where uncertainty appears to be increasing. While financial innovation continues to reshape markets, the enduring value of gold reminds us that some principles of monetary history never truly disappear. When institutions responsible for safeguarding national wealth continue to place importance on gold, it is worth paying attention. They may be preparing for a future that many investors have yet to fully recognize. Silver occupies a unique position in the financial world, and that uniqueness is precisely why so many investors misunderstand its potential. Most market participants view silver primarily as an industrial metal. They focus on its use in electronic solar panels, medical applications, and advanced manufacturing technologies. Those demand drivers are certainly important, but they tell only part of the story. The larger opportunity lies in silver's historical role as a monetary asset, and what that role could mean in an environment of increasing financial uncertainty. Throughout history, silver circulated alongside gold as a recognized store of value and medium of exchange. Entire monetary systems were built on the relationship between the two metals. While modern investors often think of gold as the ultimate monetary asset, silver has repeatedly played a crucial supporting role during periods of economic transition. When confidence in paper currencies weakens, investors do not simply seek exposure to gold. They frequently turn to silver as well, creating demand dynamics that can produce dramatic price movements. The reason silver deserves special attention is its market structure. Unlike many financial assets, the silver market is relatively small. It takes far less capital to influence silver prices than it does to move larger asset classes. This characteristic creates significant volatility, but it also creates opportunity. When investment demand begins flowing into silver, the impact can be amplified because available supplies are not always sufficient to absorb sudden increases in buying interest. Another factor often overlooked is the relationship between tea and gold. Historically, silver tends to lag during the early stages of precious metals advances. Investors initially gravitate toward gold because of its established reputation as a safe haven asset. Once confidence in the trend develops, capital often begins flowing into silver. At that point, silver's smaller market size can result in percentage gains that exceed those of gold. This pattern has appeared repeatedly across multiple market cycles. At the same time, silver faces growing industrial demand from sectors that continue expanding regardless of economic conditions. Modern technologies require silver because of its unique conductive and reflective properties. As industries pursue electrification, renewable energy infrastructure, and advanced electronics, demand for physical silver remains supported by forces that extend beyond investment sentiment. This creates a rare situation where monetary demand and industrial demand can potentially reinforce one another. What makes the current environment especially interesting is the growing discussion surrounding the future of the international monetary system. Rising sovereign debt, persistent fiscal imbalances, geopolitical tensions, and concerns about currency stability are encouraging investors to reconsider traditional assumptions. During such periods, hard assets often receive renewed attention. Gold typically leads the conversation, but silver's historical behavior suggests that it should not be ignored. The market's tendency to underestimate silver stems from its dual identity. Analysts who focus on industrial trends often miss its monetary significance. Those who focus exclusively on monetary factors sometimes underestimate industrial demand. The reality is that silver benefits from both worlds. It is simultaneously an essential industrial resource and a recognized monetary metal. Few assets possess that combination. Its dual role could become increasingly important if confidence in traditional financial structures continues to erode. Investors searching for assets outside the conventional banking and currency systems may discover that silver offers characteristics they have overlooked for years. Its accessibility, historical monetary role, and strategic industrial importance create a compelling foundation for long-term interest. The broader lesson is this: that major financial shifts rarely reward the assets everyone is already watching. Largest opportunities often emerge in areas that remain underappreciated until circumstances force a reevaluation. Silver has spent years operating in the shadow of larger markets and more widely discussed investments. Yet history suggests that when monetary conditions begin changing in meaningful ways, assets with both scarcity and monetary credibility can move from the margins to the center of investor attention. If that process unfolds again, silver may prove to be one of the most important stories of the next financial era.